the financial sector's evolution, job cuts, technological advancements, and the future of banking employment. The financial industry is undergoing a significant transformation, influenced by economic pressures, technological advancements, and evolving business strategies. Recent announcements from major financial institutions, such as Morgan Stanley and Goldman Sachs, regarding substantial job cuts, have raised concerns about the future landscape of banking employment. These layoffs signal a broader shift in the financial sector, driven by the increasing integration of automation and artificial intelligence, AI, cost-cutting measures, and a changing economic environment. The big question is, are these job cuts temporary, or are they an early sign of an irreversible transformation in the banking industry? Recent workforce reductions in major banks. In March 2025, Morgan Stanley revealed plans to reduce its global workforce by approximately 2,000 positions, accounting for about 2.5% of its total employees. This decision marks the first significant job reduction under CEO Ted Pick's leadership and is part of a broader strategy to manage costs and enhance operational efficiency. However, these layoffs will exclude financial advisors, focusing instead on other areas within the organization. The bank reassured investors that these workforce reductions are not driven by immediate market concerns like inflation or geopolitical instability, but rather by a strategic shift in business operations. Despite the layoff news, Morgan Stanley's stock price remained stable, even increasing slightly by 0.1% on the day of the announcement. Similarly, Goldman Sachs has also confirmed plans to reduce its workforce by 3% to 5%, translating to 1,400 to 2,300 job losses based on its 4,600 employees, while specific details regarding the affected departments have not been disclosed. This move aligns with Goldman's broader efforts to streamline operations and optimize costs in response to global economic uncertainties and rising automation trends. These workforce reductions highlight three key trends currently shaping the financial industry. Automation and AI are replacing traditional roles. The rise of AI-driven technologies is reducing the need for human employees in certain banking functions. Cost management is a top priority for financial institutions. Banks are under pressure to reduce expenses, particularly as economic uncertainty lingers. Workforce morale and job security are at risk, with continuous waves of layoffs. Financial professionals are facing increased workloads and greater competition for jobs. The role of automation and AI in banking. Automation and AI are fundamentally changing the financial industry. Banks are investing heavily in technology-driven solutions that streamline operations, cut costs, and increase efficiency. Some key areas where automation is making an impact include AI-powered customer service. Banks are increasingly using AI chatbots and virtual assistants to handle customer inquiries, reducing the need for large customer support teams. Automated trading and portfolio management. Many investment firms and hedge funds now rely on AI algorithms to execute trades faster and more accurately than human traders. Fraud detection and risk assessment. Machine learning models can analyze millions of transactions in real time, helping banks detect fraudulent activities and minimize risk. Loan processing and underwriting. AI is being used to automate credit scoring and loan approvals, allowing banks to process applications faster and with fewer employees. Banks leading the AI revolution. Several major financial institutions have already embraced AI technology, signaling the direction the industry is headed. JPMorgan Chase. The bank has reported that its AI-powered coding assistant has increased software engineers' efficiency by 10% to 20%, allowing developers to focus on more strategic initiatives. Commonwealth Bank. Australia's largest bank has significantly improved efficiency by implementing AI to reduce customer service wait times by 40% and cut scam losses by 50%. Wells Fargo. The company has revealed that AI is set to impact nearly every aspect of its business, from corporate finance to customer service operations. The rise of AI in banking is inevitable, and while it brings increased efficiency, it also poses a major threat to traditional jobs. According to a Citigroup report, up to 54% of banking jobs could be displaced by AI over the next decade. The future of banking jobs: will AI replace humans? With automation taking over routine tasks, many banking professionals are wondering, is my job at risk? The answer is, it depends. While some roles are becoming obsolete, new opportunities are also emerging. Banks are now hiring more AI specialists, data scientists, and cybersecurity experts than ever before. The problem: many traditional finance professionals do not yet have the technical skills required for these roles. To stay competitive in the evolving financial industry, professionals must adapt by learning new skills. Here's what employees can do: develop AI and data analytics skills. Understanding how AI systems work can open doors to new career opportunities in banking. Build expertise in cybersecurity. With banks handling more digital transactions, there is an increasing demand for cybersecurity experts who can protect sensitive financial data. Stay updated on financial technology. Fintech trends: fintech startups are disrupting traditional banking, and staying informed about the latest innovations can give professionals a competitive edge. Enhance soft skills. AI cannot replace human creativity, critical thinking, and relationship management. These skills will remain valuable in client-facing roles. What does this mean for investors? If banks are cutting jobs and shifting towards automation, what does this mean for investors? Short-term volatility: layoffs in major financial institutions can trigger uncertainty in the stock market, leading to fluctuations in share prices. A long-term growth potential: banks that successfully integrate AI and automation could see higher profits and improved efficiency, making them strong investment opportunities. Sector rotation: investors should keep an eye on fintech and AI-driven banking firms, as these companies are likely to outperform traditional institutions in the long run. Despite job cuts, the banking industry is not dying. It's evolving. Investors who understand these shifts and position themselves strategically can benefit from the technological transformation of finance. Final thoughts: where do we go from here? The recent layoffs at Morgan Stanley and Goldman Sachs are not isolated incidents. They reflect a larger shift in the financial sector. Banks are restructuring their workforce, investing in AI, and prioritizing automation to stay competitive in a rapidly changing market. For finance professionals, the message is clear: adapt, upskill, and prepare for a new era in banking. Traditional roles are disappearing, but those who embrace technology and innovation will thrive. For investors, the future of banking presents both risks and opportunities. While layoffs may create short-term uncertainty, companies that successfully integrate AI and automation will lead the industry in the years to come. So, what do you think? Are these job cuts a sign of a healthy financial sector adapting to new technology, or are they a warning that the industry is in trouble? Drop your thoughts in the comments below. Are you worried about AI taking jobs, or do you see it as a positive step forward? Like, subscribe, and turn on notifications so you don't miss the next big financial update. Stay informed, stay ahead, and stay prepared for what's next.